Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Ed Pierzak, Senior Vice President of Research and Economist at Nareit, to discuss Nareit's latest release of T-Tracker data, which measures the strength of REIT performance on a quarterly basis. Ed, it's great to have you with us. Welcome to Trade Talks.
Well, thank you, Jill. Appreciate being here.
You got it. And the second quarter data shows that REIT balance sheets are solid and well-positioned for economic and capital market uncertainty. What were some of the highlights from the data?
Yeah, so, Nareit T-Tracker, it's really a great tool. It's available quarterly and it tracks REIT operational performance and balance sheets. And when we take a look at REIT balance sheets, we really see that REITs have been maintaining what I would term proper balance sheets. They have low leverage levels. When we take a look at fixed rate debt, over 90% of total debt, secured debt, which is a real competitive advantage. They end up at just under 80%. But maybe most importantly, when we take a look at the average term to maturity, it's quite long. It's nearly 7 years. And then the average cost of debt is at 3.7%, which is really significantly below the current 10-year treasury. And then really on top of that, when we kind of hop over and we take a look at some of the operational performance, we see that REITs have been doing quite well there as well. And so when we take a look at FFO growth, over 4% year over year. Similarly, when we take a look at same store NOI growth, that was over 5%. So we see that REITs have been keeping up with inflation, really well positioned for any uncertainty in the marketplace.
Were there sectors that performed better than others? I would imagine office space was a little bit more challenging than some of the other sectors.
Yeah, so with sectors, that's always the case. And I think maybe one of the ways to best look at that is to take a look at how dedicated REIT managers, active managers, take a look at sectors. And, it's maybe not surprising that we see a lot of these active managers taking more interest in what we would kind of term the modern economy sectors, and this includes things like cell towers, data centers, healthcare, and self-storage. And when we see that, it's really not surprising, because if we actually take a look at the evolution of the REIT indices, if we went all the way back to 2000, we'd see that the four traditional property types, office, retail, apartments, and industrial, they accounted for over 75% of the index. And today they're approximately 40%. And I think some of the surprise may be that infrastructure or cell towers is actually the largest sector, and that data centers, in fact, are larger than the office allocation. So when we take a look at some of the overweights and underweights, you see that active managers today are overweight industrial, residential, healthcare, and data centers, and they're underweight office. And I think that, for all market participants, these really may not be that surprising. But I would want to point out a few things on office. I think number one is, as we kind of take a look at the current situation, we're really kind of in the middle of a natural workforce experiment. And we're really not going to know the outcome for a little bit of time. And with hybrid work or work from home, employees may not be going into the office, but in fact, we see their employers are continuing to pay rent. We see this in our T-Tracker numbers as well. And then also, I think as we just kind of take a look at office, it often gets kind of painted with the same broad brush. And what we see is that the market's in fact bifurcated, where we end up seeing some of the newer, highly amenitized, well-located properties doing quite well performance-wise. And in fact, REITs own a lot of these properties. And then lastly, I think everyone talks about the challenges of office, but in fact, REIT office total returns did have a bit of a bounce that started back in May of this year.
All right, Ed, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you. Bye-bye.